We're gonna talk about LLCs and break down the top 5 write-offs every LLC owner needs to know. What's going on, guys? My name is Shamir Borgelin, and I'm a tax strategist who works with 6- and 7-figure entrepreneurs and real estate investors just like you. And as a business owner myself, I've used these write-offs to save thousands. And I know how powerful they can be. Here's the thing, the tax code is built to benefit entrepreneurs, but only if you know how to use it. Most business owners think taxes are just a cost of just doing business, but they're not. They are a game. And if you know the rules, you win every time. Starting an LLC is a great move, but it's not enough. You need to know how to make it work for you. Maybe you're earning 1099 income, running your business, or investing into real estate. Whatever your situation is, if you're not leveraging these tax strategies, you are missing out big time. Okay, now the problem is your accountant probably isn't telling you most of this stuff. And that's why you're here, because I'm gonna share with you the strategies that actually matter, but just without the boring stuff. So let's start with the first one, startup and organizational costs. Let's be real. We know in business, it takes money to make money. And if your business hasn't made any yet, here's something you need to know. The IRS allows you to deduct up to $5,000 in startup and organizational costs in your first year of doing business. This includes things like marketing and advertising, building your website, and even training or coaching you did to get started. For example, if you spent $2,000 on ads, $1,500 on a website, and $1,000 on a business course, before you even made a single dollar, you can deduct all of that as startup costs. Now, if you've already been making money, the good news is you can deduct all of your operation costs, things like supplies, softwares, or any ongoing costs that exceed that $5,000. Now, going back to if you didn't make any money in your first year running your business, if your expenses were more than $5,000, the extra amount gets to get spread out over the course of 15 years. So you still get to benefit. So if you're getting started, keep track of all of your expenses. You can use a spreadsheet or software like QuickBooks in order to stay organized, and make sure you're running everything through a business bank account in order to keep it separate from your personal spending. That makes tax time so much easier, and your accountant will love you. The next write-off will be your home office deduction. Now, this one is huge because if you're working from home, like most entrepreneurs are in 2025, the IRS lets you deduct a portion of your rent, utilities, and even repairs if you have a dedicated space for your work. And no, it doesn't have to be a whole room. If you've got a desk in your corner or in your living room, that counts as long as you're using it for work. So here's how it works. You need to measure the square footage of your home office. You divide it by the total square footage of your home. That percentage is how much of your rent, electricity, internet, and other expenses you can actually deduct. So let's say your home office takes up 10% of your home. If your rent is $2,000 a month, you can write off $200 a month or $2,400 a year. People always ask me, does this trigger an audit? Just take photos of your workspace and keep your bills on hand. This way, the IRS isn't gonna come knocking on your door unless something really looks off. And if it does, you have all the proof to justify taking this expense. The next write-off we're gonna talk about here is the vehicle expense. Let's talk about your vehicle, because if you're using it for business, this is one of the easiest ways to save money on your taxes. Now, you've got 2 ways to claim this deduction. Option number 1 will be taking the mileage method. You see, the IRS mileage rate for 2025 is 70 cents per mile. So if you drive 2,000 miles in the year, let's say you drove 10,000 miles in the year from meeting up clients, picking up supplies, or checking up on your rental property. If you multiply that by 70 cents, boom, you get a $7,000 deduction that you get to take. The mileage method is perfect for those that drive a lot for work. And all you had to do was track your trips. In order to calculate and track your mileage, you can use apps such as Mile IQ or QuickBooks, and they make it super automatic to track your mileage. All you have to do is just turn on the app, let it log your miles, and swipe to mark the trip as either business or personal. It's that simple. Option number 2 is the actual expenses. Now, if you don't drive as much, but you've got a more expensive car, actual expenses method could actually save you more. Here's an example. You drove 8,000 miles in a year, and 50% of that is for business. You spend $3,000 on gas, $1,200 on insurance, $1,000 on maintenance, and $4,000 in depreciation for the year. Since 50% of your driving is for business, you can deduct half of those costs in total. So that gives you $4,600 that you get to write off. This method works best if you're using a high-end vehicle like a luxury car for client meetings or showings where the costs of maintenance, insurance, and depreciation are significant. Let's talk about depreciation for the vehicle real quick. So depreciation for the vehicle just means that you get to write off the value of the car over a certain amount of time. So for vehicles, the IRS actually gives you 5 years that you get to write off the value of the vehicle. And even better, if you have a car that is above 6,000 pounds and you use it more than 50% of the time for business, as of 2025, the IRS allows you to deduct up to 40% of that purchase price in year one. So if you had a car that was $100,000 and you bought in 2025, you can potentially write off up to $40,000 in year one just off the value of the car, not including all the other expenses that I just mentioned. Now you may be asking, how do you decide between mileage method or the actual method? Well, if you're putting in a lot of miles, 10,000 or more, stick with the mileage method. It's easier to track and it usually gives you a bigger deduction. If you're driving less, however, but you have a price to your car, the actual expenses method might save you more, especially if you use the car more than 50% for business. But just remember, once you pick a method for the year, you've got to stick with it. So whether you're tracking miles or receipts, staying organized is the key to maximizing your savings for this strategy. At the end of the day, your car isn't just a way to get from point A to point B. It's also a very powerful tax saving tool. So figuring out which method works best for you. Next on the list we have is marketing and ads. You see, every business owner needs customers and getting them costs money, right? But the good news is, however, everything you spend on marketing and advertising is 100% deductible. This includes things such as running social media ads, printing flyers and brochures, paying for SEO to get your website ranked, even hiring someone to build your website. Here's why this is such a big deal. Unlike some other expenses, marketing costs aren't spread out over time. You get to deduct them in the same year you spend the money. If you're not tracking your marketing expenses, make sure you're starting today. Keep your receipts, invoices, and anything else that shows what you have spent. It's easy to forget a Facebook ad that you ran 3 months ago, but those little expenses add up. All right, guys, we're at the last one, number 5, and that is probably the best one. Electing yourself as an S Corp. All right, you got me. This one, it isn't technically a write-off, but it's a strategy that can save you thousands if your LLC is making good profits. So if you are a single member LLC or a sole proprietor, you pay something called self-employment tax on all of your profits. That self-employment tax is a nasty 15.3%. It's a combination of your Social Security tax and Medicare, aka FICA. But if you elect your single member LLC to be taxed as an S Corp, you can split your income between a salary, which is taxed at that 15.3%, and distributions, which are not taxed at that 15.3%. For example, let's say your business as a single member LLC or a sole proprietor makes $100,000. As a single member LLC, you would pay self-employment tax on the full amount. So if you did $100,000 times 15.3%, you would get $15,300 that you're paying in self-employment tax. But as an S Corp, however, let's say you were still making that $100,000. You would pay yourself $50,000 as a salary and the other $50,000 as distributions. Just by making that switch, that cuts your self-employment tax in half. This is one of the smartest moves you can make once your business is consistently profitable, but it's not something to do without a plan. So talk to a tax professional in order to make sure it's the right fit for you and to get it set up properly. We recommend at our firm, once you're making about 50 to 60K in profit, that's the best time to start talking about switching over to an S Corp. All right, so here's a recap. Deduct your startup and organizational costs. Use the home office deduction if you're working from home. Track your vehicle expenses to save big. Write off all your marketing and advertising costs. And lastly, consider switching to an S Corp if your profits are about 50 to 60K. These strategies aren't just for the IRS, they're for you. They're designed to help business owners like us keep more of our money and grow our businesses. I want to know down below in the comments, which one of these strategies do you think will save you the most this year? I'd love to hear your thoughts. If this video was helpful, please do me a favor. Hit the like button, share it with a fellow business owner, and subscribe for more content like this. Lastly, if you're ready to take your tax strategy to the next level, click the link below to schedule a free consultation with me and my team. Let's make 2025 your most profitable year yet. Thank you for watching, and I'll see you guys on the next video.